Okay. We are learning about completing the accounting cycle. So far, we've covered the first 7 steps of the accounting cycle. And today we will be covering steps 8 and 9, which completes the required steps. Okay, so we will learn to make what are called closing entries. Okay, just a reality check. This is financial accounting, chapter 5, right? Okay, good. Just want to make sure. I'm not going through the wrong material. We will learn how to then make a post-closing trial balance, which is actually super easy. We've already made trial balances, and it's basically the same thing. So that part's not hard. We will learn a couple new ratios, the current ratio and the working capital. These are both ways to measure the liquidity of the company. In other words, its ability to pay off short-term debts. And we will walk through an entire accounting cycle all the way from step 1, identifying transactions, all the way through to the post-closing trial balance. So we'll get to see what that whole process, all 9 required steps looks like, but mostly we will be working on steps 8 and 9, okay? So these are steps 8 and 9. Step 8, you close out certain accounts. The accounts we close out for the most part are revenue, expense, and dividend accounts. And the reason we close those out is so that for the next year, we can start from 0 and we can see what were the revenues last year and what are the revenues this year. So that's why we close these accounts out. Same thing with expenses, same thing with dividends. However, most accounts don't get closed out, so we only have to do it with certain accounts. And once we've done that, then we just make our post-closing trial balance using the same approach we would use for other trial balances. Okay, so I kind of said this already. Those accounts that we close out, they all impact retained earnings. Revenue has what impact on retained earnings? You can tell me.
Increase.
It increases, right? So if we think of it, you've got the accounting equation, right? Assets equals liabilities plus equity. That equity includes any earnings, any profits that the company has retained. And we know that profits are increased by revenue. And what expense what impact does an expense have on equity? Decreases, right? Expenses decrease equity and they decrease retained earnings. And same thing with dividends. Dividends also decrease equity and retained earnings. So these 3 types of accounts that we close out are the ones that impact retained earnings, which is why when we make a balance sheet, we can get all of the information we need on the balance sheet from the trial balance, except for retained earnings, because we have to update the retained earnings based on the revenue, the expenses, and the dividends. So that's the process that we'll be learning how to do today. All the other accounts on the balance sheet, again, we can get from the trial balance, and they all carry over from one period to the next. So if it's December 31st and the company has $1 million in assets, if they don't sell any of those assets or buy any new ones on January 1st, they still have $1 million of assets. Those accounts just carry over. Same thing with liabilities. If you have a debt that you haven't paid off, January 1st comes around, you still have that debt, right? So those accounts just carry over and do not get closed out, right? So we've got temporary accounts that we close out, and then we've got permanent accounts that we do not close out. The textbook sometimes uses the term real to talk about permanent accounts. And sometimes it uses the term nominal to talk about temporary accounts. To me, it's more clear if we just say permanent and temporary. So that's the terminology that I'll be using. And the way that we do this, when you get to the end of the period and you close out your revenue and your expense accounts, you're also creating your income statement, right? Which is based on your revenue and your expenses. And when you close out your dividend account, you're also creating your retained earnings statement, right? So that information goes into those financial statements, but then for the next period, you're starting at zero. Start counting your revenue again, from zero. Start counting expenses from zero, and you start counting your dividends from zero. Any questions so far? Okay, so here we see the different types of accounts. This is just a helpful reference for you to see what I'm talking about. Okay, asset accounts and liability accounts and stockholders' equity. All of those accounts show up on the balance sheet, and they're all permanent. They do not get closed out at the end of the period. Okay. Dividends, as I mentioned, those go on the retained earnings statement, and those are temporary. We close them out at the end of the period. Same thing with revenues and expenses. They go on the income statement, and they get closed out at the end of the period. Okay? So it's pretty easy to remember the difference. Broke it, but I can fix it. Let's practice. Okay. So let's go through this list and think, are these permanent or temporary accounts? Now, I've told you the three main types of temporary accounts. What were those three categories that we close out at the end of the year? Revenue, expenses, dividends, right? Okay. So if you see revenue, expenses, and dividends, you know that they're temporary. And pretty much anything else is going to be permanent. Okay. Remember though, unearned revenue, which I think is on here somewhere, is not revenue. What is unearned revenue?
Liability.
It's a liability, right? So even though you see that word revenue, remember it's not. It's lying. It's not revenue. Okay, so rent expense, would that be permanent or temporary? Temporary, correct. Unearned revenue. Permanent, right? Because it's not revenue, it's a liability, it would be permanent. Okay. Then how about accumulated depreciation? Is that revenue, expense, or dividend? It's none of the above, right? This is not revenue, this is not an expense. Now there is such a thing as depreciation expense, but that's not what this is. This is accumulated depreciation on a vehicle. That is not revenue, it's not an expense, it is not a dividend, so it would be a permanent. How about common stock? Temporary or permanent?
Permanent.
Permanent. Fees, revenue? Temporary, because that is revenue. Anything that says revenue is revenue except for unearned revenue. How about dividends? Temporary or permanent? Temporary, correct. Prepaid insurance? Permanent. And accounts payable? Permanent. So the only ones here that were temporary were rent expense, fees revenue, and dividends. Right? Did I miss anything there? That covers it. So everything else is not revenue, not an expense, and is not a dividend, which means everything else was permanent. If you get confused, you can always look back to this chart, right? And this will tell you. So here we see a trial balance. We know step 8 is closing out those temporary accounts. The way we do that is with journal entries. And then, of course, every journal entry has to get copied over to the ledger. And once we do that, every account that we just updated in the ledger now has a new balance, right? So then if you make a trial balance, it's going to impact the trial balance. So we do the closing entries in the journal, copy them to the ledger, and then make a new, what's called a post-closing trial balance. What does post mean in this case? Post-closing trial balance. That, well, post has a specific meaning after. It's like the opposite of pre is post, right? So a post-closing trial balance is made after you've closed out your accounts. It's the final trial balance, okay? So that's what we will be learning to do here. Do it again. I guess every time I change something over here, I need to like reset this clicker. Okay, so it's a 4-step process to close out the temporary accounts. And I don't think it's super hard, because I don't think this is one of the hardest chapters, but it does have, it takes a little getting used to. It does have its own little complexities. This is the first step in closing out the temporary account. We start with revenue. Okay, now let's think, is revenue part of deal? No. What was deal again? Remind me which accounts? Yep, dividends, expenses, assets, and losses, right? And what was the significance of deal? Yes, those are the accounts that when they increase, we record it on the debit column, which is on the left. And those accounts that are part of deal will normally have a debit balance, right? All the other accounts, when they increase, we record them on the credit side, and those accounts normally have a credit balance. So where does revenue fit in? Is revenue part of deal? No.
Girls.
What's that?
What girls?
Part of your gross profit, that is true.
No, girls. The other.
Girls, misheard you. Okay, that makes more sense. But both were true. Yes, it is part of the girls acronym, which I didn't go over in class, but those are the accounts that increase on the credit side. Okay, that is correct. So revenue increases on the credit side and normally has a credit balance. So if we need to close out your revenue account that has a credit balance, you need to debit that account and get it down to 0. So if we go back to this trial balance and we find this company had $10,100 of service revenue. That was, oh, and they also have some interest revenue. Okay, let's see, is this the same company? Yes. So notice those are on the credit side, right? Because revenue will have a credit balance. So what we have to do is debit both of these revenue accounts by the exact same amount to get them down to 0. And that's what's happening here. We're debiting interest revenue, $140, debiting service revenue, $10,100. And now, once that gets copied over to the ledger, and you look at your new balance in the ledger, what is the balance going to be in each of those accounts? 0, right? Because they had, like, interest revenue before had a $140 credit, Now we debited 140 and that gets it down to 0. Because that's how we do math in the ledger, right? Same thing with service revenue. It would have a 0 balance. We have closed out that account so that we can start over next year from 0. But if we're debiting these two revenue accounts, we have to credit something, right? And this is a new account you haven't seen before. It's called income summary. We only use that account when we're closing out the books. So it's just, it is a temporary account, but it kind of just appears that one day and then we close that one out too. Okay. So that is what we credit. And that is the first step in the closing process. Any questions so far? Oh, here we see the ledger now. Before we closed out the revenue, the service revenue account, these were all the credits from all the sales that had been made, and they totaled up to this $10,100 credit balance in service revenue. But remember, we just debited the same amount, and so now the balance is 0. That's how it works, right? When you have something in the opposite column, you subtract that amount to get your balance. Same thing we can see over here. The company had earned $140 of revenue from interest. Apparently they had made a loan to somebody and they earned interest on that loan. And now we are closing out that account with a debit, getting the account down to 0. But remember, we had to credit something, so we credited income summary. And if we go to the income summary account, we see that $10,240 that we credited. Right, we record that here in the ledger. So that's the balance in the income summary at this moment. Right. Are we ready for step 2? Step 2, okay, step 2, we close out our expense accounts. Now, our expense accounts part of deal? Okay, so do they normally have a debit balance or a credit balance? Debit, right? So to close them out, we need to credit them. And that's what's happening here. We're crediting out each of those expense accounts to get them down to 0. We total up all of those expense accounts, and we have to debit the same income summary account. Okay, and let's see what that looks like in the ledger here. So the supplies expense account previously had a $100 balance. We credited $100, now it's down to 0, right? Same thing here, salaries expense had a $5,100 balance. We credited $5,100, get it down to 0. But now if we look at the income summary account, we have the previous credit from when we closed out revenue, and then we have the debit from when we just closed out the expenses. When we subtract this debit, it leaves us with a credit balance, $4,665. If we had more expenses than we had revenue, we would end up with a debit balance in income summary, which would decrease our retained earnings. But when we have a credit balance like this, that's because we had more revenue than we had expenses. We call that net income. And that will increase our retained earnings. Okay, so whether we had a profit or not, whatever's in the income summary account is going to impact retained earnings. Okay, so that is the second step. Anything need clarification? Any questions? Okay, let's see. Oh yeah, here we can see on the income statement. Remember, the income statement is revenue minus expenses, right? We see the same 2 revenue accounts that we closed out. We see the same expenses that have all been closed out. And when we take our revenue minus expenses, we get our net income. We see that is the same as what's in the income summary account. Okay, you can see how it's all connected. You might be wondering, but wait a minute, we closed these accounts out. Well, yeah, we did, but that would have been actually after we made the income statement. Because remember, making your financial statements is step 7. Step 7, right? And then closing out your accounts is step 8. All right. Step 3. This is where we close out the income summary account. Now, in this case that we saw, income summary had a credit of $4,665, right? So how do we close that out? We have to debit $4,665. So that's what we're going to do here. We're going to debit income summary. That gets it down to 0. We have to credit something, right? So we credit retained earnings. So that same amount that was the result of our revenue minus our expenses is what's increasing our retained earnings. That's how your profits make their way onto the balance sheet. Now, if it had been the other way around, if this company had a net loss, then we would have had a debit balance in income summary, and then we would have had to credit that account and reduce our retained earnings. So really, of the 4 steps in this 4-step closing process, step 3 is the one that sometimes can be a little bit confusing, because if the company had net income, it's going to look like this. It's going to be a debit to income summary, credit to retained earnings. You might want to write this next part down if you're taking notes. If the company had a net loss, it will be the opposite. You'll have a debit to retained earnings, and then you'll have a credit to income summary if there's a net loss. Okay? So now we can go in, we see the credit here to retained earnings, which increases the equity of the company. And then over in the income summary account, remember we had that first credit that came from closing out the revenue. We had the debit that came from closing out the expenses. That left us with a credit balance. And now we just debited that same amount and we're down to 0. Okay, that is how step 3 works. Step 4 is really not hard. If the company paid out any dividends, you're going to debit retained earnings, because remember, the dividends are getting paid out of the profits of the company. So when you pay out dividends, it reduces the profits. It reduces the equity of the company by reducing retained earnings. And you have to clear out the dividends account. Is dividends part of the deal? Yep. So normally has a debit balance, and the way we close it out is we credit. Okay. Step 4 will always look like this. It's always going to be a debit to retained earnings, credit to dividends, unless the company did not pay out any dividends, and then you just skip step 4. Okay. So here we previously had a credit balance and retained earnings of $4,665. We just reduced it by $100 because of the dividends. So our final balance and retained earnings is $4,565. And we're done with the 4-step closing process. Okay. That's step 8. We can see the relationship here, how this was the retained earnings from closing out the revenue and the expenses, right? It's the same as our net income, which is revenue minus expenses. However, here we have the $100 dividends that we had to close out as well, right? So on the retained earnings statement, we see those same amounts. And we see the end result was the same $4,565. Because again, the retained earnings statement starts with your beginning retained earnings, which in this case was 0. They had no profits carrying over from the previous period. They added their net income, subtracted their dividends, and came up with ending retained earnings. Okay. So it all fits together like a complex three-dimensional puzzle, but everything is there for a reason and it all works together. All right, so any questions? No? Okay. What do we see here? All of the permanent accounts, oh, over here. Okay, the ones with the green arrows, those are the temporary accounts. At this point, those have all been closed out. All of the revenue, which we see here, all of the expenses, the income summary account has been closed out, dividends have been closed out. The only things that remain at this point are the asset accounts, liability accounts, common stock, which is one of the equity accounts, and retained earnings. Because all the temporary accounts got closed out. Right, so here we have an exercise. Let's do this one together, or at least we'll start it together. And take it from here. Okay. So here's a scenario where it's the end of the month. We completed our post-closing trial balance. What step is that? Post-closing trial balance? Step 9. So in other words, we've done the whole accounting cycle. We've closed out the books for the year. We're ready to go home. But what we find out in the, there's a service revenue account still listed on your post-closing trial balance. Remember that in step 8, we closed out revenue along with expenses and dividends. There shouldn't be any revenue account that still has a balance. So we've goofed up somehow. So now what do we need to do? Make sure our books are closed out. If we have an account that's not closed, we need to close it, right? And how do you close a revenue account? What was step 1 of the 4-step process we just did? Whatever is the amount in that revenue account, I did not mean to rhyme there. We're going to have to debit. And then we'll credit income summary. And then we'll transfer that journal entry over to the ledger, update the balances of those accounts, the revenue account and the income summary account. We'd have to do step 3 again as well. We'd have to close out the income summary account. And then we could try again to make our trial balance. And it, this time, since now the revenue accounts are all closed out, it should come out right. Okay. Company has revenue of $48,000 and expenses of $52,000. Do they have net income or a net loss? They have a net loss, right? Yes, their expenses are greater than their revenues. So what would the closing entry look like for the income summary account? That's step 3. Which account would we debit? Which account would we credit? Yes, we would credit income summary and we would debit what? Step 3. Retained earnings. Okay. To keep that in mind, is retained earnings part of deal? It is not, correct. It is not part of deal. So remember, if we have a profit, retained earnings is gonna go up, and that's gonna be a credit to retained earnings. If we have a loss, retained earnings will go down, and that will be a debit to retained earnings. Okay, I know these concepts might be a little hard to grasp, but hopefully by the end of the chapter, it all makes sense. Okay, it says to prepare closing entries for this company here. Is that it? They just want us to do that. Let's see. Closing entries. Yeah, I guess they just want us to do that. That's a different company. Okay. Okay, so let's just walk through this in our minds here. If this is our adjusted trial balance, okay, the adjusted trial balance is step 6. After we have this adjusted trial balance, we can make our financial statements, which is step 7, and then we can close out the accounts, step 8. So that's what they're asking us to do. Which of these accounts would get closed out? Yes, that's exactly right. So these are all permanent accounts, all the way to retained earnings here. So we would be closing out, well, first we would do the revenue account. In this case, it doesn't say revenue, but fees earned is revenue. It means this company provided some service, earned some fees, and that's revenue. We would close out the expense accounts, which are all these, and we would close out dividends. Right? How would we do that? We would use that 4-step closing process. And once we've done that, remember that our retained earnings will now have changed because of either the net income or the net loss. Right? The net income increases retained earnings, net loss decreases it. And then the dividends will have also decreased the retained earnings. So at that point, once these accounts are all closed out and we know what our ending retained earnings is, we actually already have a post-closing trial balance. So we'll go through some exercises like that later. Okay, so prepare a post-closing trial balance. Okay, there it is. That was easy. Now notice, let me ask you this way. Are there any temporary accounts on this post-closing trial balance? Do you see any revenue, any expenses, or any dividends? Nope. They've all been closed out. That's why they're not here. And whatever profit or loss and dividends, those all impacted the retained earnings, bringing the retained earnings to that final balance. So, so I guess this is before. This is the same company? No, this is a different one. Okay. Oh, this is a problem. Okay, let's work on this problem. So if you have the ability, go ahead and open up the problem set. It's weird. Huh. Okay, cool. Okay, so here we just have a list of transactions for reference. And those transactions, you can see here summarized. And we'll see if the company used the cash basis of accounting, we would have different results down here than if they use the accrual basis of accounting. Very different results, even though they're the same transactions. Now, who remembers what's the difference between cash and accrual types of accounting?
The money is due before the action.
So, well, you're on the right track there, Maya. So It's with the accrual, the action happens first and you pay the money later. Which is true, and that does relate to what we're talking about here because that only applies if you're using the accrual basis of accounting. If you're using the cash basis of accounting, the action and the financial transaction are considered to be one and the same. Right? If you're using the cash basis of accounting, when do you count something as a sale? The cash basis. Anybody remember? If you're using the cash basis of accounting, when do you count something as a sale?
Cash.
When you get the cash. And expenses you would count when you pay the cash, right? Whereas in the accrual basis, there's a possible separation between when the sale occurs and when you get paid for it, or when the expense is incurred and when you pay for the expense, right? They could be in separate periods of time. In the accrual basis, which one do most companies use? Accrual, correct. And this helps illustrate why companies are not only likely to use accrual, but for the most part, they're usually required to use the accrual basis. The reason is it gives you a clearer view of your actual profits or losses. You see how here the net income is fairly stable month after month. And that's because their revenue is fairly stable and their expenses are fairly stable. And so the results that it gives also are fairly stable. Now, this accrual basis is giving us an accurate representation of what's going on with the company. The same company with the same transactions, if they based everything on cash, we would see that the revenue from the first couple months, the customers didn't pay until March. So it looks like the company did not have any sales those couple months when they did. And here they made a major payment for an expense. They paid for an insurance policy all at one time, but here they're only counting $500 of expense every month, which is more accurate because it's a year-long policy. So we get a lopsided view here. It looks like they're losing a lot of money here in January and making a lot of money in March. That is true about what's happening with the company's cash flow. But what we want to know is their profits, right? That's also important. So using the accrual basis takes the same information and presents it in a way that shows more clearly their actual profits or losses in each period, okay? So that's just a reminder of the difference between those two approaches to accounting. Any questions or comments there? Okay. I've been telling you that the way that we define something as current means within a year, right? Whether it's an asset or liability, current means within a year. And that's mostly true. But there is an alternative. Some companies instead use an operating cycle instead of a year. And that's another new term for us. So an operating cycle is how long it takes from when the company purchases or makes its inventory until it sells the inventory and then gets paid by its customers. So that period of time is considered one operating cycle. For simplicity's sake, we're just going to use a year when we're talking about current versus non-current. But this is another important concept just to be aware of. Okay? So the operating cycle is basically from the time the money goes out to when it comes back. All right, kind of like a boomerang, right? Okay, and then this is important because there's another thing I haven't really told you. Because I've been keeping a lot of secrets here. There we go. That's what I was. Oh, wrong slide. Okay. This is what I was trying to do. Okay. So one thing I have not told you is that on a balance sheet, sometimes you break up your assets into multiple categories. So it's not just current assets and long-term assets. God bless you. Long-term assets can have several different types. And investors and other people that look at financial statements like to understand what types of long-term assets they're looking at. And the same thing can be done with liabilities. You can break out your liabilities into current and long-term. So if you're not sure what category or what classification an asset falls into, this chart could be really helpful. Okay, it's a little hard to read, but I'll walk you through it. You start here where it says asset, and then you go to the first box and say, okay, is this asset cash? If it is, it's a current asset. Or is it an asset that will convert to cash within a year? Or will it be used up within a year? Or will we sell it within a year? And here it also says, or within an operating cycle, but we'll just keep with a year. If any of those things are true, then it's a current asset. Okay? If none of those things are true, then you go to this box. Is it a tangible asset? Meaning, is it something physical? Currently used to help generate revenue. So for example, is it a building or land or a piece of equipment? So it's something physical that we're using to help make our product and generate revenue. If so, it goes into this category, property, plant, and equipment, sometimes abbreviated PPE. What do you think plant means in this situation?
Manufactured.
Factory. Not like a tree, but like a factory. Okay, so property, plant, and equipment. Those would be long-term assets used in the production of your business. Now, what if it does not fall in that category? Okay, then you go down, there we go, down. Okay, then you go down to this box. Is it a stock, bond, or other long-term investment? So if it is an investment and it's long-term, it goes into this long-term investment category. If it's none of the above, it must be your only option left, which is called an intangible asset. Okay, so we can use this flow chart to determine, is it a current asset or is it PPE, a long-term investment, or an intangible asset? Those are going to be the 4 classifications of assets that we will be working with. What would be some examples of intangible assets? Copyright? Yes, copyrights, trademarks, patents are all examples of things that you can own that have value, but you can't touch them, they're not tangible. Okay. Any questions on this flow chart and how to use it? Yes, Maya. Yeah, so we have current assets. We have PPE, property, plant, and equipment. We have long-term investments. And then we have intangible assets. Okay, great. Let's see what's next here. Classify each of the following as current asset, PP&E, long-term investment, or intangible. Same 4 categories. So let's go through this and check our understanding. Machine, how would we classify that? PPE, correct, it's equipment. What about a patent? Intangible. Supplies. Current, yes, supplies would typically get used up within a year. What about a building? Yep, it's property, so it would fall under PPE. How about an investment in bonds with an intent to hold until maturity in 10 years? 10-year bonds. Those would be long-term investments. If you had bonds that you were planning to sell next week, they would be current assets. Even though they're investments, because they're short-term in nature, they would be considered current. Okay, copyright. Intangible. Land being held for a future office. It would be property. If it said land that the company owned, that it wasn't using, but hoped to sell for a profit someday, that would then be an investment. But if they're using it or planning to use it in their business, that makes it part of PPE. Prepaid insurance. Current asset, that is right. Accounts receivable. Also a current asset. And then an investment in a stock that will be held for 6 months. Well, it would be a current asset. It is a short-term investment, but the category we would put it in would be current assets. So anything under a year just falls into current assets. Okay, so it's not that hard, right? A new concept, but hopefully it kind of makes sense. Here we see a classified balance sheet. So it's a balance sheet just like we've made before. What makes it classified is we have assets broken into current assets and PP&E. So we broke it down into 2 different classes. So that's all there is to it, really. Okay, another problem. So we'll go to problem number 12. Okay. Next concept. Liquidity ratios. I think we might have discussed this before, but what's meant by the word liquidity in accounting?
How easily you could make it cash. Or like sell it for.
Yeah, how easily you could take your assets, turn them into cash, and pay off any short-term debt. And so we have these liquidity ratios that measure your ability to take assets, current assets, and turn them, pay off debt, which would be current liabilities. So, excuse me, one way we can measure that is what's called working capital. You simply take your current assets and you subtract your current liabilities. In other words, how much money could the company really come up with within a year, including any cash it already has, but also selling inventory or doing anything else it can to take its current assets and turn them into cash. So what's the amount of cash they could come up with in a year to pay off their debts that are due within a year, their current liabilities? And the difference is the available capital, the available cash that the company has to work with. We call it working capital. Okay, that is a term you will hear out there in the business world, not just accountants, but executives and companies will throw it around. Say, hey, how much working capital does this company have? It means how much money do they really have to work with? So it's a pretty simple formula again, just current assets minus current liabilities. Then we have current ratio. Notice it's the same 2 things, current assets and current liabilities, but instead of, God bless you, instead of subtracting, you divide. And when you divide, that gives you a number. In this case, you took the company's current assets divided by their current ratios, we get a number of 4.91. What that number means is that their current assets are 4.91 times higher than their current liabilities, which is a good thing. If you owe somebody $100 this year and you've got $500 this year, well, you've got 5 times as much in assets as you owe, right? You want that ratio to be as high as possible. If it were negative, that would be bad. Would it be? No, it's not. It wouldn't be negative. If it were less than 1, that would be bad, because that would mean your liabilities were bigger than your assets. Okay, so let's practice this, exercise 12. I think you'll see how easy this concept will be. Okay, so you've got a landscaping business, it says. You've purchased some expensive equipment in your first month, and you have a low working capital and a low current ratio. So in other words, you don't have a lot of money when you compare how much cash you would have after paying off your short-term debts. And the ratio between your current assets and liabilities is not good. Now you're 8 months into business, so 7 months have gone by, and you're seeing growth in sales, which is a good thing, but your working capital and current ratio are still low. Let's think about that. If your sales have gone up, does that mean your current assets have also gone up? They would, because either if your customers paid you, your cash would go up, or if they haven't paid you, your accounts receivable has gone up. Both of those are current assets. So since your sales have been good, your current assets are good. And why then are we not seeing a significant change in the working capital or current ratio? Exactly. Our expenses or our liabilities, technically, our liabilities are also going up, right? Because your working capital is your difference between current assets and current liabilities. If they both go up, you still have the same working capital, right? What you want is your assets to grow higher and your liabilities to go lower, right? That will improve your current ratio and your working capital. Okay, these are all the steps in the accounting cycle, including the optional step, which we don't even go into, so don't worry about step 10. Here we see a whole list of transactions. What we're going to do now is see the entire accounting cycle, okay? And because we don't have that much time, I'm just gonna go through it, just do your best to kind of follow along. But start to finish, the whole 9-step accounting cycle. Okay, so here the company starts off with an investment of $70,000. So that's a debit to cash, credit to common stock. The cash increases assets and equity goes up from the stock, right? Okay, then they buy some barbering equipment. They do that using some cash, but also accounts payable, so they haven't paid the full amount. Well, that account payable is a liability. The cash they paid out is here. That's an asset going down, but then they also got the equipment. That's an asset going up. Are they still in balance? Yep. Remember, our accounting equation always stays in balance. Then they buy some supplies for cash. Okay, those are both assets, so they cancel each other out. Then they do $4,000 worth of work. Did they get paid for this work? No, they did not. Customer's going to pay them later. That's called an account receivable, which is an asset. but they did do the work, so that is a sale. Right, it was journalized as revenue. And that increases equity. Okay. They pay a utility bill. Well, that means that they had some utility expense and cash goes down from the payment. Right? The expense reduces their equity. All right, then they got some cash in advance from a customer, but they haven't done the work yet. This is unearned revenue, right? Which is a liability. Okay, they actually paid out some dividends. So they document the dividends and they document the cash that got paid out. Dividends decrease equity, right? Because they're getting paid out of the profits of the company. It's transferring the value that's within the company to the investors, and now it becomes their property, not the company's. All right, and then they get cash from a customer for work that they did. Cash goes up. And again, it's more revenue because they did the work, causing equity to go up. They paid down a debt that they have, so their liability goes down. It was an account payable, meaning it was a debt to a supplier. And they used cash, so cash goes down. Okay, they paid some cash in salaries expense to employees. Expenses decrease equity, and cash going down decreases assets. Then, let's see, a customer now pays them. So the company got cash, that's an asset going up. But the customer was paying down a receivable, right? So that is an asset as well. And because the customer paid it down, that asset went down. Okay, this is all those transactions as they would have appeared in the journal, right? Because we know the journal is one long list of all the transactions. This is what the ledger would look like, all the individual accounts. Here we see the asset accounts are over here. We've got the liability accounts, and then all of the different equity accounts. The asset accounts all have a debit balance. The liability accounts all have a credit balance. And the equity accounts, it depends, right? Some will have a credit balance like common stock and service revenue because those increase equity. But the ones that decrease equity, dividends and expenses, will have a debit balance. They're also part of deal. Okay? So that's all review, right? It's all things we've seen before. Now, we can make the unadjusted trial balance by taking the balances in each of those accounts and then just putting them in this document, making sure all of our debit balances equal the total of our credit balances. Okay, so that's our unadjusted trial balance. This is step 4 in the cycle. Then we have to make some adjustments, step 5. So here are the adjustments. We find out we've used some of our supplies. We debit supplies expense, which reduces equity, and we reduce our supplies, which lowers our assets. Let's see, depreciation. On our long-term assets, we need to take depreciation. So that is an expense, again, reducing equity. And now remember accumulated depreciation. Who can tell me what type of account that is?
That a contra asset.
There you go, Julian, gold star. It is a contra asset account, so it reduces the value of our assets. We did some of the work that we owed a customer, so we have to make that adjusting entry. So the unearned revenue goes down with a debit. So we see the liability going down, and then we can count it as revenue, which increases our equity. Now notice we have a liability going down, we have equity going up, they cancel each other out, and we are still in balance. Okay, because they're on the same side of the equal sign. Then, let's see. We earned some interest. So again, we made a loan to somebody and we earned some interest from that loan. They haven't paid us yet, so we have interest receivable. Just like accounts receivable, that is an asset, even though we didn't get the money yet. And then the revenue that we earned increases our equity. Okay, we owe some money for income tax. So we can document that as an expense because it's for profits we've already earned, so it's already happened. That reduces our equity, but we haven't paid it, so it's an income tax payable. That increases liabilities. We're still in balance. So here are the journal entries for those adjusting entries, okay? All of those get transferred over to their individual accounts in the ledger. Now our updated ledger looks like this. I think we've added a couple accounts since the last time we looked. And we would now make the adjusted trial balance, right? Because we've made the adjustments. So we just take those balances, we make our adjusted trial balance, again, our debits equal our credits. Notice that among the assets here, we've got a contra asset account that has a credit balance, right? Accumulated depreciation is an asset account, but it has a credit balance. Okay. Now we can make our financial statements. Step 7? Yeah, step 7. First, we make the income statement, total up all of our revenues, total up our expenses. The difference is our net income or loss. In this case, it's a very small profit of $25. Now we can make our statement of retained earnings. We take our beginning retained earnings balance. In this case, it was 0. Add our net income, subtract our dividends. That gives us our ending retained earnings balance, which we're going to need on the balance sheet. So on the balance sheet, all of this information comes from the trial balance. We can get all of the assets, all the liabilities, most of the equity. The only thing we can't get from the trial balance is that ending retained earnings that we just calculated, right? We use the retained earnings statement to figure out what this ending retained earnings comes out to. And we see our balance sheet balances. Then we close out the temporary accounts, right? Step 1, we close out revenue. Step 2, close out expenses. Step 3, close out the income summary account to retained earnings. And step 4, close out the dividend account to retained earnings. Okay, now we've closed out all those temporary accounts, so our ledger is a lot simpler. Oh, these are the ones that got closed out, I guess. Sorry about that. I guess what we're supposed to see here is that these are all zeroed out, with one exception. Which account has a balance? Retained earnings, right? That is a permanent account, and we see now, if you remember from the retained earnings statement back here, the ending retained earnings balance is 125. Actually, it's negative 125, right? This company paid out dividends and it didn't have enough profit to do that. So that negative $125 is a debit to retained earnings. It reduces how much retained earnings we have. All right, now we can make our post-closing trial balance. So here we just take the balances from the assets, the liabilities, the common stock, and the new balance from retained earnings. Normally your retained earnings is going to have a credit balance. In this case, the company has spent all their profits and they paid out dividends. They probably shouldn't have paid out dividends. So this is a rare case where we see a debit balance in retained earnings, but you see that we are in balance. So they must have done it correctly. And wow, our summary slide. Okay. So we've learned a lot this chapter, right? We've covered a lot of new concepts and terminology. We learned the closing process to close out the revenues, expenses, and dividends, so that those accounts all have a zero balance, right? The reason we do this is so that we can then start from zero for the next period and start counting how much revenue we have for the next year, how much expense, and how much in dividends. So those are the temporary accounts. The ones we do not close out are the permanent accounts, right? The balances in those permanent accounts just carry over to the next period. Okay. And the process to close out the temporary accounts, we start with revenues, then expenses, and we close out income summary to retained earnings, and then we close out dividends. 4 steps. We do that with journal entries. That then impacts the ledger, which impacts the post-closing trial balance. All right, we know that the cash basis of accounting is only used by some small companies and nonprofits. Most companies use the accrual basis. We know what that means. We know it means you count a sale when you perform the service or provide the product, not when you get paid. Right? When you count an expense, when you incur that expense, not when you pay for it. And it gives us a more accurate view of the profits of the company by using the accrual method. Okay, we know we can classify the balance sheet by breaking down assets into 4 categories: current, PP&E, long-term investments, and intangibles, right? And then we can also break down liabilities into current and long-term. We know liquidity is how we measure the company's ability to pay off its short-term debts using short-term assets. And when we subtract current liabilities from current assets, we get working capital. When we divide, we get the current ratio. There we go. Okay, any questions? We have a few minutes before break. I'm gonna suggest, let's mix things up a little bit today. It's 2:38. Let's just go ahead and start our break now. So come back at 2:48, okay? And then we will go through the exercise set. We'll see you in 10 minutes.